Yeah, so for August, if you looked at the start of the month and the end of the month, there wasn't that much of a difference between where we started and ended from an equities perspective. If you look through the month, though, it was quite a bumpy month, and we've done an update with the investment committee members earlier in the month. If you want to get into the detail of what actually happened of the Japanese carry trade discussion. But equity markets were down anywhere between 5 and 20% intra-month. But by the end of the month, they'd largely recovered that, and Aussie markets were slightly positive for the month, and some of the global markets were slightly negative for the month. Yeah, in reporting season through August, we had domestic and offshore companies reporting, so giving an update on what's been going on in their operations and also a bit of an outlook statement as well. As we've been hearing for quite a period of time, there's those that have been impacted and consumers that have been impacted by higher interest rates and those that are benefiting from it, and that's coming through in many of the company reports. So cost of living pressures was highlighted by many companies as being impactful to their earnings. Inflation generally is being impactful to many companies' earnings, and other input costs as well. So labour and energy prices is also a bit of a concern that some companies have been flagging as well. Performance-wise, the technology sector performed the best, which is probably not unexpected given the earnings growth that's generally coming through, which is at a higher rate than the other parts of the market. Domestically, the materials part of the market was challenged. As we know, commodity prices have been volatile and probably a bit weak, and so that's impacting earnings, even though there's probably reasonable dividends that are being paid through by some of those companies that they're confident in what's been generated, but maybe not so confident on the outlook. We've been hearing a lot of news and headlines about the Magnificent Seven, which is the big companies in the US, the businesses like Apple, Amazon, Alphabet, to name a few, that have been performing exceptionally well, that have generally had quite high earnings growth, and you can understand that they're global businesses that have got certainly global reach, and they're businesses that are pervasive in life today, that they're in all businesses in terms of how they operate, generally with Microsoft and their applications or devices that you use on a regular basis in your hand. The market through reporting season has adjusted a little bit in terms of what the growth expectations are and what other opportunities there are in the marketplace. So the S&P 500's effectively been split between the top 7 and the remainder of the companies that are in the index, 493 other businesses. There's a big broad spread of different businesses and different sectors that you can get exposure to with those additional companies, and the concentration risk that's in that part of the market is quite high. And so the market's having a look and considering to see what other opportunities there are in that 493 companies, and you're starting to see a bit of a rotation and some support for those businesses, more so than what there has been over the last few years, where those tech companies have performed very strongly. The expectations now in the US, which is probably sort of 3 to 6 months ahead of where we are, that they're likely to cut rates this month. So as they go to meet later in this month, they're looking and likely to cut interest rates. There's still speculation by commentators in the marketplace as to how big that cut is. So do they cut by 25 or 0.25% or 50 basis points? And so that's still a bit of uncertainty in markets, and that's playing through in terms of the other volatility that we saw earlier in August, where you had equity market volatility. The concern there that was, well, there's some economic data that's coming through that's not as positive as what was expected, and that flowed through into higher volatility and yields in the fixed interest part of the market. And so that's still likely to persist, I think, in terms of the fact that we've still got a little bit of uncertainty as to how soon and how much interest rates are cut, and what that means for longer term interest rates as well. Inflation will still be in focus, jobs markets will still be in focus. and the magnitude of interest rate cuts, certainly in the US, will be in focus. So anything of a cut certainly is in expectation now, and you know, it's at least probably an 80 or so % chance of a 25 basis point cut. If it goes further than that, that's probably an indication that economic conditions in the US are slowing faster than what the central bankers were expecting. But generally, I think over the next 6 to 12 months, there's still probably about a 1% cut forecast by markets for the US cash rate. Domestic cash rate is expected to fall as well, but not likely until early in the new year. So while that's not happening this month, certainly the commentary from the RBA will be of interest to watch to see what they're saying and what further insights they're looking at and seeing before they start to consider anything on a cut basis.